Aquí estamos de vuelta. Estamos de vuelta. Segunda parte. Bueno, sí. Buenos días, buenas tardes o buenas noches. Bienvenidos al segundo episodio del día de DividendosTv. Vamos a ver en unos minuticos, ya en 8 minutos, sale la decisión de la Reserva Federal, donde decidirán si van a cortar, mantener o subir los intereses. Media hora después viene a hablar Ernesto, el dueño de todo esto. No, mentira, J. Powell. Y no sé por qué, pero por eso no sabía ni qué hacer, porque estoy mirando que como que en la gráfica el mercado se está posicionando para una caída. No sé, ojalá que me equivoque. Ojalá que sí, ojalá que no, no sé. No sé si será algo temporal, pero me parece que esta vez la visión financiera, lo que nos va a decir según los datos, etcétera, de lo que están mirando ellos, creo que va a ser algo negativo. Creo que él viene hoy lo que le dicen hawkish, como en modo águila, y creo que eso va a ser un impacto grande. Tal vez me equivoco, no sé. Pero bueno, antes de comenzar, si eres nuevo en el canal, por favor suscríbete, dale me gusta al video, compártelo siempre. Recuerda, invierte tu dinero, compra la fábrica, no los productos. Recuerda que yo no soy ningún asesor financiero, todo lo que digo o hago en este canal es con fines de entretenimiento. Insto a todos y a todas a que hagan su propia investigación antes de participar en algo que requiera tiempo o dinero. Ahora me voy a poner aquí chiquito porque yo todavía estoy desayunando. Casi termino, pero ya me bañé, preparé todo el almuerzo porque de aquí, cuando Powell termine de hablar, ya tengo que vestirme y irme para el trabajo. Ok, entonces, mientras tanto, vamos a esperar aquí. Ok, ya en unos minuticos sale la decisión. Y no es la decisión la que va a afectar, creo. Yo lo que veo aquí, por lo menos en mi gráfica, es una ¿cómo se dice? Una bandera bajista, bird flag, ¿ven? Y esto aquí, no, o sea, no veo ningún punto de rebote así como hemos visto otras veces. Creo que esto se está preparando para una buena caída. Pasó unas órdenes de SPYI, nice. ¿Compraste algo? Todavía no he comprado nada. Bueno, lo que he comprado hoy, no, hoy no he comprado nada. Mira esto, SPYH que casi no cae. Bueno, ha venido cayendo poco a poco, claro. Pero todavía está unos centavos por encima de mi costo promedio. Bitcoin también en un día prácticamente perdió lo que subió en una semana. Había subido como, sí, 8, casi 9% en una semana. Hoy me metí que ha perdido 3, casi 3.5%. Estuvo a 4%, la mitad. So, aquí todo el mundo se está preparando. Waiting for the Fed decision. O sea, prácticamente. No sé si qué sería más rápido, si encontrarla aquí en la página o que en la noticia los digan. Vamos a ver. Ok, déjame aquí terminar rapidito con mi huevo, mi queso y mi pan. Mientras tanto, aquí Gonzalo nos sigue ayudando con las últimas noticias. Estrategia de Trump: destruir las capacidades de Irán, poner fin a la guerra rápidamente. Según Axios, una cita a un funcionario de la Casa Blanca, Estados Unidos, pretende eliminar las capacidades de misiles nucleares y navales de Irán para luego poner fin a la guerra. El cambio de régimen se considera un beneficio adicional, no un objetivo principal, y tiene menos interés en Estados Unidos que en Israel. Siri prevé que el petróleo Brent alcance a los $110-120 por barril ante el aumento de las tensiones en el Medio Oriente. Eso fue lo que te mandé ahorita. Siri espera que el Brent llegue a los $110-120 por el barril en los próximos días debido a las interrupciones en el suministro provocadas por el conflicto. En un escenario alcista, los precios podrían dispararse hasta los $150 y $200 si Irán ataca más infraestructura energética o si el estrecho de Hormuz permanece cerrado. En un escenario bajista, el precio podría situarse entre los $65 y los $70 si se llega a un acuerdo que reabra los flujos. Siri también prevé una escasez en el suministro de aluminio. Y bueno, ya yo lo que estaba leyendo de JP Morgan es que para finales de abril, o en abril, lo cual sería increíble porque en abril del año pasado, abril 2025, fue los aranceles. Abril 2026, entonces, conflicto en el Medio Oriente. El barril, dice JP Morgan, que si llega a los $150 para abril, entonces estaríamos en un escenario de recesión. Y que la inflación, esto podría ayudar, lo cual, o sea, ayudar a que la inflación suba a 5%, lo cual sería empeorar la inflación. Falta un minuto. Yo espero estar en la página correcta. Tiene que ser aquí. O es 3:18. La decisión ya está, ya pricing, ya todo el mundo sabe lo que va a pasar. 1 de la tarde.
To in the 90s off the back of a shock in the Middle East and a major rally over the past 2 weeks plus. The scores heading into this decision look like this. Equity markets this afternoon on the S&P declining by 0.6% in the bond market. We're looking at 2s, 10s and 30s shaping up as follows. Yields on a 2-year at 3.71. With that Fed decision, here's Mike McKee.
No change in rates, no change in dots, one dissent, but some big changes in inflation expectations. Fed officials see one cut still in 2006 at some point, even though their statement notes that uncertainty about the economic outlook remains elevated. 3 members who favored no cuts in this year moved their dots down to 1. The statement goes on to say, the implication of developments in the Middle East for the U.S. economy are uncertain, and the committee remains attentive to risks to both sides of their mandate. They still see one more cut in 2027. Stephen Myron, the only dissenter, he wanted a 1/4 point cut this time, and from the dots, we discern that he still wants 100 basis points at some point this year. The language about future moves remains the same. They still talk about the extent and timing of additional adjustments to the target range. It's the summary of economic projections in which we see a lot of changes. PCE inflation this year is forecast at 2.7%, up from 2.4% in December. Core is also seen at 2.7%, up from 2.5%. Both drop to 2.2% next year, up from 2.4% in the December SEP. Core is seen at 2.7% this year. Both drop back, as I mentioned, next year. to 2% in 2028. GDP marked up a tenth in both years, both of the next 2 years, to 2.4% this year and 2.3% next year. The unemployment forecast remains 4.4% in 2026, dropping to 4.3% next year. That's up from 4.2% in December. And the longer run estimate for Fed funds, seen as the proxy for the neutral rate, rises a tick to 3.1%. Guys?
Mike McKee, thank you, sir. We'll catch up with you a little bit later. Let's start with the price action. We'll go equities, then bonds. We'll have a sneak peek of what's happening in the commodity market because we're tracking that throughout the day here at Bloomberg. Equity markets, looking at the S&P 500, off session lows, but still negative by 0.5%. In the bond market, yields slightly higher on a 2-year by 2 basis points, basically as you were at 370 on 2s, on 10s at about 421, which is basically where we were going into this decision. So this is what we're doing. You go into the projections. We'll ignore the statement just for a while. We'll go into the statement and we'll look at the projections and compare what they were projecting back in December.
So sí, la Reserva Federal dejó los intereses sin cambio, o sea, los dejó como mismo estaban, que es lo que esperábamos. CME Watch. Ahora faltan 41 días para el próximo meeting, la próxima decisión. Y al igual, a ver, no, este es de hoy todavía. Pero hasta ahora igual se espera que no tenga ningún cambio para abril 29. Diablo, ¿no era esta la página? What the hell, bro? Tengo que encontrar la página y guardarla. Ok, de momento estamos bien. A ver qué dice Powell. Sí, ese es el que va a hacer el cambio. Ese es el que va a dar con todo.
Right? It's in there in the forecast.
And that's the reason why you're seeing the yield curve steepen. And on the margins, you're seeing 10-year yields higher on this because ultimately this is a Fed that is willing to stay on hold.
¿Qué pasa? Que esto del petróleo va a lastimar bastante la inflación. Y si ya nos están poniendo aquí que la Fed vuelve a repetir que la inflación se mantiene más o menos elevada, él va a venir a decir una de las dos cosas, o las dos cosas. Una de que va a ser transitorio, lo cual, a ver, todo es transitorio. Si te pones a pensar, todo es transitorio. El mercado baja, es transitorio. Si sube, es transitorio. Porque en algún momento, como dicen, todo lo que sube tiene que caer, ¿no? Si estás enfermo, es transitorio. A no ser que tengas algo terminal. Que termines, tú sabes, bien malo, feo. Que no haya marcha atrás. Pero uno es que diga que es transitorio. Y de alguna manera que vire la tortilla, como dicen. Que vire todo a lo más positivo posible. Para evitar un panic sell-off. Una venta de esa en pánico. O realmente va a decir de que esto puede traer grandes consecuencias. Que va a subir la inflación. Que va a bajar las ganancias. Que el unemployment, ve, no hay, el unemployment se mantiene un poquito cambiado, pero job gains have remained low. O sea, como que todo pinta entre la espada y la pared. Eso es lo que yo le tengo miedo a Powell, porque si él dice algo negativo, fácil lo tumba. De que lo tumba, lo tumba. Fíjate que mira todo lo que hemos hecho y no hemos llenado este gap. Mira, esta fue la, a ver, ¿dónde fue? 18, aquí. La apertura de hoy, caímos y hemos rebotado prácticamente 2 o 3 veces en el mismo lugar. Se critica aquí de estos niveles, pero no hemos bajado a llenar este gap. So, uno, o en algún comentario el mercado aprovecha, el algoritmo aprovecha, baja, llena ese gap y rebota en el mismo nivel que rebotó anteriormente, lo cual formaría como un double bottom, un doble suelo. ¿Ves? Puede hacer aquí así, entonces, pero eso es en un momento positivo, en un comentario positivo. Si esto se viene feo, entonces, ¿cuánto? No creo que haya tanta fuerza para caer tanto, pero yo no creo que vaya a caer otro 1.2%, 1.10% adicionales. Pero todo puede ser posible en este mundo. Si dice algo bien negativo, vamos a ver entonces ya bastante cerca o rebotando en el movimiento de 200 días en la gráfica diaria. O baja, se mantiene bien cerca y espera entre jueves y viernes a ver qué pasa el fin de semana. Si el fin de semana Donald Trump por alguna casualidad baja la guardia, entonces el lunes tendríamos un gran rebote después de probar nuevamente el movimiento de 200 días, que es un movimiento súper clave. Nos toca esperar. Ahí pasé la noticia de resumen de la Fed. Vamos a ver por aquí. Ok, esta también que no la leí. Se espera que la administración Trump levante pronto las regulaciones sobre la gasolina de verano para reducir los precios de la energía fuentes. Diablo, tengo que buscar cuál es la opción donde sale ese reporte. Y aquí está el resumen de la decisión de la Reserva Federal, 18 de marzo de 2026. La Reserva Federal suspende los recortes de tipos de interés por segunda reunión consecutiva. La Reserva Federal prevé un recorte de tipos de interés en 2026 y otro en 2027. La previsión de inflación del PCE de la Reserva Federal para el 2026 se revisa al alza hasta el 2.7%. La Reserva Federal afirma que las implicaciones de los acontecimientos en Oriente Medio son inciertas. Esto puede ser algo como lo que yo estaba explicando. El gobernador de la Reserva Federal, Miran, discrepa a favor de una bajada de los tipos de interés. La decisión sobre las tarifas de hoy se tomó como una votación de 11-1. Creemos que en diciembre fue la última bajada de tipos de interés por parte del presidente de la Reserva Federal, Jerome Powell. Sí, porque yo creo que... A ver, bueno, sí. Es que todavía... Creo que es en mayo que él se va. Eso no, yo pensaba que no, pero creo que falta hasta abril 29. Sería la última decisión que toma J. Powell. O sea, no él, sino como presidente de la Reserva Federal. Ahorita viene lo peor.
Those that are sitting on rare earth minerals and other minerals, and those who aren't. And I think we're seeing all of that play out. But I will tell you, our client base still feels underallocated to emerging markets, both equity and fixed income. We're seeing those allocations continue to come in. I think there's a good tailwind there.
We just went along to Australia.
There you go. Back-to-back hikes at the emerging market central bank over the RBA. See that?
Yeah.
Honestly, there's some offended people down under right now.
I'm not wearing it on this one, but I will say that tomorrow will be really interesting with the BOE and the ECB.
There you go. You tell them, Bramo.
All right.
Rich Cloud is still with us. Rich, I want to come to you on an important topic to wrap things up. A really serious one. The future for Chairman Powell. This is not how usually these things play out. Typically, how this plays out, the chairman knows when his term finishes, he gets a great send-off, he walks away, and he does a $1 million speech in about 12 months' time and has a happy retirement. This feels so different, Rich. Kevin Walsh is ultimately being nominated. We have no idea when the confirmation hearing is going to be. Bob Michaels sat here a little bit earlier and said he thinks the chairman, Jay Powell, is still going to be there by the time you get to the midterms. Rich, how do you think this process is going to play out in the next several months?
Well, you're absolutely correct. This is unprecedented, unusual. That the handoff is usually pretty smooth and very well telegraphed. And the difference, of course, now is several fold. One, of course, is the the DOJ investigation of Powell that the Fed is pushing back on. In addition, of course, even Walsh getting a hearing is now up in the air.
A ver, por aquí tenemos otra declaración del fondo FIAX, 12 centavos, 8.02% anual. Y también otros de Defiance, IWMY declaró 11 centavos, QQQY 13 centavos, WDTE 17 centavos, GLDY 10 centavos y US Oil 9 centavos. Esta honestamente no sé ni cuál es. ATCL declaró 28 centavos. Esto es nuevo entonces porque todavía no tiene cuánto va a pagar. ATCL. Bueno, sí, hablando de lo que estás preguntando, que alguien te explique por qué sacaron CHPY de Wimax y pusieron a Connie. No sé, honestamente. Tal vez tendremos que esperar a que hagan otra entrevista y que le hagan esa pregunta al manejador a ver qué rayos dice. Vaya, como único que de verdad, por suerte y casualidad, tengamos un gran rebote en Bitcoin así inesperado, que entonces mande a Coinbase a la luna. Pero así lo tenían en el pre-rebalance. JPO era de JP Morgan, ¿no? JPO. No sale ni la gráfica aquí. Soxy, que también es súper estable, también la quitaron. El fondo del oro. Apple, me imagino que es de Apple. Diablos, que no ponen una. Este tiene que estar positivo. What? Come on. Tampoco. O sea, comparado con AAPW, de aquí de Roundhill, este es leverage. So, claro, por aquí va a estar más negativo. Ok. 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 Ya en un año está más negativo el de Geomax. Este salió en febrero de 2025, solo agarró Liberation Day y lo desplumó. Ay, Dios. Estamos en... Mira, estábamos ahí en 6.666 de nuevo. Ahí está. Uf. Sacan los fondos ganadores para poner a esos fondos. Por cierto, empezamos a caer. Este fue fuerte aquí. En un minutico ahí. Diablo.
Case. So I don't understand, Bob, and I guess that this is my question. Is the reaction function essentially they will hold pat even in this scenario? Or do you have a sense of what the reaction function is to true stagflation?
Well, the bottom line is the market is just looking through the Fed right here and saying, doesn't make sense, don't get it, don't know what they were thinking. The projections don't make sense to me, but I know where we are. There's a lot of tension still in the Middle East. It's yet to completely play out. I think where we are now is about fair. It can go either way from here. So it's completely dismissive of the FOMC statement.
Hey, Stephanie, before you go, what's the number one question for Chairman Powell into this news conference?
Yeah, I mean, the biggest question is going to be, provided energy prices are elevated through much of the summer, how are you going to think about the balance of risk? Is this going to be something that you're going to, look through, and do you expect that growth is going to be lower as a result? Or is this something that you're worried about, more similar to 2022? And what are the balance of risks in your mind in terms of how this could play out?
Stephanie, good to see you. As always, thanks for jumping on. Stephanie Roth there of Wolf Research. To build on the conversation, Diane Swank of KPMG. Diane, I'm going to use a quote of yours to ask you the question. A dual mandate or a dueling mandate? What have we got?
A dueling mandate, and I think that's a real problem. I think the Fed is this dovish sort of numbers don't add up. I think I agree with that completely. A dovish pause is not what I would expect. I would have expected some people to actually put in rate hikes in this meeting, and they didn't. And I think there's a real issue about, we saw rate cuts in late 2024 to shore up the labor market. We didn't get any jobs. We saw rate cuts in late 2025 to shore up the labor market. I don't think we're going to get a lot of jobs from those. That brings up the issue is the problem in the labor market more structural and systemic, something that rate cuts alone cannot cure and spur the demand for workers on? If that's the case, if you cut rates further, you're risking a more persistent bout of inflation, or worse, a stagflationary scenario. And I think the devil in the detail is in that stagflation scenario. Also important is that they raised their non-inflationary rate. That is reflecting, yes, productivity growth and the idea that the economy can grow more robustly without having inflation, but that also means higher non-inflationary rate, which is an important marker to put down before Kevin Warsh takes on as Fed chair, since he has argued that productivity growth should lower that non-inflationary rate. That is not what the Fed is saying, and I think that's very important. But I am very concerned about, we've 5 years in, we've got consumers expecting more inflation than they did in late 2024. And those expectations are going to rise, especially with salient prices like prices at the pump going up. And there's already a long tail due to the problems in the Middle East. Production idled is not easily brought back online. It's weeks to months, and we're rolling supply chains the world over. You create scarcities that go below the destruction in demand. That gives you stagflation.
Diane, is this the Fed meeting where forward guidance just died?
Absolutely. We didn't have a lot of forward guidance to begin with, but absolutely. And I think, what really will be interesting in the chairman's comments is what was the debate in terms of growth, what went into these numbers, how did the debate fall out. I think the devil in the details here is that there is a bit of a stagflationary concern out there, and there should be.
Diane, there's we suffer from 3 zip code scenario here in New York City. You've got a much greater national perspective. I take real issue with a narrow part of America being affected by $5 a gallon gas. How much of America is going to be flat on their back from some of these shocks?
Well, unfortunately or fortunately, we do have fiscal stimulus right now, and that fiscal stimulus will help absorb the shock instead of going into other kinds of spending, and that will help households. Tax refunds are showing up in consumer bank accounts right now, but the combination of fiscal stimulus with, remember, inflation is accelerating right now. We saw PCE accelerate. We saw the PPI numbers today. The translation of the PPI and the CPI for PCE for the month of February, hotter, especially on core services. That's aside from what's going on in terms of tariff-based inflation. That is important right now, and I think that's getting lost in translation, but it does show up in the devil in the details of those dots and how the forecasts show up. You could have had one very strong forecast push up the GDP number within the group. There are people who believe within the administration that we'll get 5 to 6% growth this year. That was their forecast going in. If Steve Moran wrote down a number like that, that would have raised the overall growth figure, when in fact the rest of the committee is seeing a more stagflationary scenario. I do think it's a dovish pause. That is a bit disappointing right now, given where we're at, even though I'm very worried about the labor market. I just don't think the Fed can cure what ails it.
So, Dan, what do you think the emphasis, where do you think the emphasis will be in this news conference with Chairman Powell in about 5 minutes' time?
I think the emphasis is going to be on uncertainty and wait and see, and that will just sort of be where they are right now, and that they don't know where the next rate move is actually going to be, and I think that's the right way to play it.
Dan Swank. Dan, always good to catch up with you. Thanks for being with us. Dan Swank there, breaking down the Fed decision. If you are just joining us, welcome to the program. The news conference about 4 minutes away with the chairman of the Federal Reserve down in Washington, D.C. In any other time, At any other moment,
Wow.
we'd be talking about the penultimate meeting of the Federal Reserve Chair.
Por un momento pasamos por ahí por 6.666.66. Wow, eso lo voy a ver después en el video, lo voy a tener un screenshot porque eso no se ve todos los días.
Partly because we don't know when.
Sí, HPY está buena para comprarla, pero vamos a suponer que baje a $50, bro. Por ahí más o menos. Vaya. Por eso yo te digo que si es bueno que caiga, las buenas, porque ya uno sabe de que son difíciles de comprar, ¿ves? Las malas, olvídate de eso, las malas siempre están listas para comprar todos los días. En los fondos estos de Roundhill, Geomax, Red Shares, todos los días están en especial. Fondos como este, los de NEOS, Goldman Sachs, JP Morgan, esos fondos es una vez al año. Y hay que tomar ventaja. Pero este fondo, tú te imaginas comprar a 50. Vaya. Tiene que bajar $7 más, que no creo. La última vez bajó a 55.18. Vamos a ver un ejemplo. Que se dé una resbaladita por 54. 54. Muchachos, mira esto. Ya 54 para arriba, que sigamos creciendo. Como normalmente crece el mercado, la bolsa de valores, la tecnología, etcétera. Y seguir recibiendo dividendos toda la semana. Lo más lindo del mundo. Aquí está Wimax después del de la arregladita, de la pasadita de mano que le dieron. Pero no veo, no sé, vamos a ver. Tal vez sí funciona. Yo sé que hoy ha caído 1.6%. Yo creo que ni el oro. Bueno, si el oro cayó 2.4%. Eggy, nunca dudes de su protección a la caída. Sí, está bien. Debería estar negativa como 5-8% hoy, ¿no? Mira. What the hell, bro? Igual yo vendía 37.
In just a moment, the chairman of the Federal Reserve entering the room.
Llegó Ernesto.
Leaving interest rates unchanged. Let's take a listen to the chairman of the Federal Reserve.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain.
Ahí viene.
We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. From last September through December, we lowered our policy rate 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total core inflation, it's about 3%, and some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the S&P, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? I'm just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions. And if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut, and each person has individual, stories behind what they want to do. But essentially, it is that the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Thank you, Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen the progress that we had hoped for on core goods and on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy. It just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
The consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there. They can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So in the thing I really want to emphasize is that nobody knows. You know, the economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. That you know, to your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down, and we don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement, and you also, what you've written down before you'll be reluctant to move too far away from that just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is, the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs with little growth in either demand or supply. But the U.S. economy is doing pretty well. It's just we don't know what the effects of this will be, and really no one does.
Steve.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increases to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So your question was?
What the staff is saying about, and has said in the past.
Yeah. So there'd be an offset.
Offsets, yeah.
So that's true. We're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, meaningfully higher. So I wouldn't say there's much of that happening. Not much will be happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that having looked through tariff inflation and inflation running above target and looking through the oil price shock would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully, but of course that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And, it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can cause trouble for inflation expectations. And so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%. And, I think it's important that we do that. Very important.
Nick.
Nick Timmeros, Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay. So I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system. And we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system so that goods inflation will return closer to what it's always been. I mean, it used to be, for many, many years, it was negative. And then, the year before tariffs came in, it was 0. And it's running at like 2% now. So, and so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates, or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks, and we feel like where we are now is just kind of on that borderline, the higher borderline of restrictive versus not restrictive. And we feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Labor non-housing services they basically moved sideways for a year. They're at the same level. And we do expect that they will come down, but it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services. But we're not seeing progress there. So we do, what we expect for next year is what we want to see for this year, rather, is continued progress on housing services, finally seeing that, the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see. But it's a good question why we didn't see much of that last year.
Edward. Thanks, Chair Powell. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation, CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable, and in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you can. We're at 3.0% core inflation, 2.8% headline. So we've been well above the 2%, that amount, whatever it is, 0.7, 0.8. or a full percentage point above 2% for some time, and that's a concern. You know, we need to get back down to 2%. And we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve Chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet. And I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today? Thank you.
You know, it's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply-side story, has changed despite the quite negative number in February. Would that be the right take, and was there anyone else in the room who thought differently, and that the February jobs report was cause for concern?
So I think you have to take the two together. You know, in a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent really, growth in the labor force, which of course we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now that's balance, okay, but I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So we look at that, we see it, we get it, and I mean everybody understands the arithmetic, and that's you can say the break even is zero, but nonetheless it's something we're watching carefully, and are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there, and but nonetheless something we watch carefully.
Andrew.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common, and does the central bank need to start taking account of the risk of supply shocks as a more common problem?
You know, we did go through a long period where the shocks were all demand shocks, and you know, so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years for sure. And it's just a very different thing, and a much more difficult thing, because it does immediately raise the question of tension between the 2 parts of our mandate. But you know, has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And you know, the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But you know, there's people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but you know, I guess, you know, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So, you know, we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. I wish we had been able to do some things, but you know, we didn't. So maybe the next chair will take a look. I'm sure he will.
Michael McKee from Bloomberg Television and Radio. The minutes show in January some members of the committee wanted to include a 2-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a 2-sided policy warning would there be?
So it did come up today. The possibility rather that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case, and of course we don't take things off the table. But you correctly characterized what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question now?
That was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the Strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You know, you can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing, that kind of thing. The truth is, it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens, and it'll come down to how long the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business services as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of of inflation expectations and the risks from higher oil and gas prices?
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you know, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth. No. But has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by a tenth, and I think that's probably to do with just growing confidence in productivity. But sorry, and your second question was just.
If there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there's tension between the two goals, right? The upward risk for inflation and downward risk for employment. So, and that puts us in a different situation. You know, when we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal, and we have inflation that's 1 percentage point above that. So calling that stagflation, it's not. I would reserve the term stagflation for a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s, and I reserve stagflation for that, the word for that period. Maybe that's just me.
Elizabeth. Thanks so much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I don't have a forecast on that.
When we're thinking about the impact on American households, as you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course people will feel that, but I don't want to speculate about what that might mean, because honestly that would sound like I have some idea of what's actually going to happen, and I don't think anybody really does. We're going to see how this works out, and I just would leave it at that.
Victoria.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, how the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting? I mean, if we have oil prices, above $100 a barrel the entire time until the next meeting, is that going to change your wait and see stance? Like, what would lead you all to move, or are you on hold pretty indefinitely?
We'll have to wait and see. I mean, we always say we're going to learn more by the next meeting, and usually we do, but in this case we're going to learn a lot, because we're going to learn 6 weeks to the day till the next meeting, and we're going to see whether what happens is it's going to be very important for the way the economy looks and the way the outlook evolves. with what happens in the Middle East, that's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And we did talk about alternative scenarios a little bit, but it's just, I wouldn't bring that in here. It's very uncertain, and I just want to just remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve, or even if things remain as they are, the economy could still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just, made it's been strong through a whole bunch of challenges. I mean, if you go back to 2023 when we raised rates a lot in 22 and 23. And close to 100% of economists called for a recession, which didn't happen. In fact, 2023 was a really strong year. So, the U.S. economy has really been just doing pretty well through a lot of significant challenges over the past few years. It's been amazing to see. And I don't know what's going to happen in the next intermeeting cycle, and I don't know what's going to happen in the Middle East. I wouldn't want to speculate.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision, and it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next year. They should be a classic one-time thing. People say the same thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, it would be over. So I don't have tons of confidence on that. I mean, I think that the theory is probably right, but as usual, the time it takes to get all the way through the economy is just very uncertain. And we found that coming out of COVID, that the inflation did go away, and largely for the reasons we thought it would, but it took 2 years longer than we thought. So I think we have to be humble about knowing how long it will take for tariffs to go all the way through the economy. And so what we've been doing is, our staff's been doing, it's very interesting. They started off with just an estimate because there wasn't a real history, and then they built, based on the history that they're seeing of tariffs coming through into prices, they can now have an arc. And for all the tariffs, they can say, well, so we have, I think, a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see further increases, and we should start seeing that more and more in the middle parts of the year. We do expect that. Now, you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision, but the administration said they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So that's how we think about it.
Thank you.
Hi, thank you. Chris Rugaber, Associated Press. You talked about the shortcomings of the SCP in this environment. I wanted to ask about, or throw in an additional thing, which is the fact that it is happening before transition. Is there still some value, perhaps, in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms of having a whole committee expressing its views, is that something that locks them in for the rest of the year.
No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. You know, it's your opinion at a moment in time, which can change based on events. You know, sometimes very quickly. So it never locks people in. You know, people are more than happy to be proven wrong in either direction, and so I just think we do it. And you know, I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think, but you know, we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one though, I think it's even more than usual good to take the forecast with a grain of salt, because subject to just very high levels of uncertainty.
Brian. Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is, you know, there were big price increases all around the world, by the way. Everywhere in countries like the United States had basically the same kind of thing. It was a global inflation coming out of the pandemic, and everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly. But people are not feeling good about it yet, and it will take some years of positive real earning gains for people to feel good again, we think. But you're right. But when you talk to people, they do feel squeezed, and you know there are areas where prices are still going up, like insurance. Various different kinds of insurance are getting more and more expensive, and that's just catching up really from inflationary pressures that take a while to get to into the price. So we take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what people are experiencing, and you know what it does for us is, you know, makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs, and you know, stable prices is half of our mandate. It's one of our two mandates, maximum employment being the other. I mean, look at every advanced economy that looks anything like the United States, anywhere in the world, in a market economy, in a democracy, and you'll see, you know, pretty much central bank independence that looks a lot like, in some cases, stronger than what we have. But it's critical that we have that so that we can do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. I have two questions. One, how high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates? And then secondly, diesel prices are rising faster than gas prices. How concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you an example or a specific answer on the first question. You know, we're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. You know, in terms of diesel prices. So your question there is, are we concerned about it? I mean,
how concerned, and whether or not it will drive up, you know, the cost of food and other goods that really rely on it to.
So I think it's a more general concern than that. It's diesel prices, because that's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many things. So, and those there are big effects in headline inflation, but things like that leak into core as well. And the effects may not be as big, but they're quite real and they're material. So we are aware of that and we're watching it, but we're right at the beginning of this, and we don't know how big you just don't know how big this will be and how long it lasts. It may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see. Thank you.
Archie, for the last question.
Thanks very much. Just to sort of stare into the future for a little bit, I was looking at the longer run bits of the SEP. I noticed that the growth estimate had been revised up a good chunk from 1.8 to 2, and the kind of long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Yeah, I think it's just productivity. We actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago, and that's not because of generative AI. We won't know for years what it's really due to, but it could be due to the kind of things that people did during the pandemic to economize and somehow become more productive because there was an incredible labor shortage. But I think the economic forecasters are very skeptical of periods of high productivity because they're so rare and they're often revised away. And for many of us, I never thought I'd see this many years of really high productivity, and by the way, expect it to continue. And we haven't really started to see the effects of generative AI, and that should certainly contribute to that. So it's quite unusual, and it's this is the higher productivity is the thing that allows incomes to rise over time. And so it's a great thing. Was that your question?
Yeah, no, I was just curious what lay behind that. And just briefly on that as well to finish up, you hear the argument a lot, this is a sort of disinflationary story, and if you believe that productivity thing, that should also weigh down inflation over time, maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates
I think you have to be cautious about that, in particular if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere, and that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question because it's really is the demand growing faster or slower than the supply side. And I think we just don't know that answer ex ante going in. We'll just have to wait and see. Thank you very much.
The chairman of the Federal Reserve. If there was a good meeting to scrap the forecast, then this one was probably it. The chairman de-emphasizing the projections, re-emphasizing the uncertainty, focused on the shock in the Middle East. We had one question. How would they respond to it? Would they look through it? The answer, it's not that simple. Equities in response negative. Near session lows right now, down 1% on the S&P 500. Likewise on the Nasdaq. In the bond market, 2s, 10s and 30s. Yields higher, particularly at the front end of the yield curve, up by 7 basis points on a 2-year, 3.75. If you, like me, thought this would be boring, this was not a snooze. The Federal Reserve Chair asked about succession. Take a listen to what he had to say.
If my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet.
3 points from the chairman of the Federal Reserve. Let's go through them individually. Point 1, I will stay on as chair until a successor is confirmed. Point 2, I have no intention of leaving the Fed while the DOJ investigation is ongoing. And point 3, even after that is complete, I haven't made a decision on how long I'll stay on. A big headline in that news conference.
He actually engaged with the question. We all were wondering whether he would give some sort of clarity, and we've got it. He is going to be the Fed chair until Kevin Warsh is in the seat. There's this question of what is well and truly over in terms of the investigation actually mean. A lot of people are going to be wondering that. And the fact that he hasn't made a decision yet. What is going to tip the scales for him to understand when he can make the decision?
Bueno, seguimos cayendo. Tremendo arroz con mango. Tremendo arroz con mango. Dice Gonzalo, bueno, dijo que no estamos en stagflation. Bueno, todo el mundo dice por el concepto de que stagflation en realidad es alta inflación y alto desempleo. Pero lo que quiso decir es que para él, comparado con los años anteriores, que creo que dijo los 80, ¿no? No era nada comparado. Y bueno, una de las, creo que de las cosas positivas que dijo fue de que la economía de Estados Unidos siempre se ha mantenido súper strong, súper fuerte, a pesar de todo lo que hemos pasado por los últimos 5 años, que dice que en los últimos 5 años hemos pasado por más, tú sabes, por más obstáculos en la economía de Estados Unidos que en muchos años atrás consecutivos. Por aquí un resumen, poquito a poquito. Powell, ¿habrá algunos efectos en la inflación en el futuro? Dice Powell, se esperan ver avances en la reducción de la inflación arancelaria para mediados de año. Yo lo vi para mí un poco bastante neutral. Dijo las cosas que tenía que decir. Powell, si no se ve un progreso en la inflación, no se recortará las tasas de interés. Así de fácil. De lo que estábamos hablando en el rebalance del fondo de Wimax, Hamburger le comentó, best ETFs, they have CHPY and SOXY out. And let's put Misty in. Yep. Pros on causing never Russian. There you go. ¿Ve? La pregunta es, ¿por qué? No sé, bro. Yo creo que ellos tienen montado ya un negocio redondo. Acerca de Powell, simplemente no sabemos, por supuesto, cuáles serán los efectos del aumento de la energía. Pero se espera que si sigue aumentando el petróleo, el crudo, por supuesto que va a aumentar la inflación en todo, la mayoría de las cosas. Lo cual, aumentando la inflación, aumentando el crudo, va a aumentar el desempleo, lo cual nos va a llevar como que nos está cerrando el paso, el camino, llevándonos a todos a una recesión. Dijo Powell, estamos en una situación difícil. Creo que ahí fue donde hizo aquí. Y con todo eso seguimos cayendo. Dice Powell, si Warsh no está confirmado antes del final de mi mandato, yo asumiré el cargo de presidente pro temporal. Fed Powell reservaría el término stagflation para, ya saben, una situación mucho más grave. Esa no es la situación en la que nos encontramos. Lo que tenemos en cierta tensión entre los objetivos y estamos intentando gestionarla. Es una situación muy difícil, pero no se parece a nada a lo que afrontamos en la década de 1970. Pues sí, vaya, creo que Bitcoin igual sigue cayendo. El mercado sí se lo tomó en serio. Aquí está el S&P 500, el Dow Jones negativo 1.55%, el S&P 500 1.18%, el Nasdaq 1.24%. Y a ver, todavía falta media hora para el cierre. Yo creo hay dos opciones. O llegando el cierre, hacen algún tipo de rebote, solamente un buy in the dip, o tal vez llegamos a algún tipo de bracket del algoritmo y la venta se intensifica. Ahí tenemos otras en 50-10 para más SPYI. En QQQI tengo órdenes en 50-10 también, creo, ¿no? 50-10. 50-80. Y 50-50. Nada se salva. No, estamos... Mira, el oro en 4.847. ¿Será esta la verdadera caída del oro? El oro negativo 3.20% hoy, la plata 4.13%. Déjame decirte, si esto no nos impresiona, no sé qué será. X-Day, el X-Day es hoy. Y el mercado negativo 1.14%. Y mira los fondos, vaya, exceptuando el oro, porque el oro o el oro cayó, ¿ves? Pero si vemos los fondos de QQQI y el SPYI, vaya, los que están más atados a los índices del Nasdaq y el S&P 500, han hecho un trabajo fantástico. Porque si sacamos una cuenta más raw, el Nasdaq está negativo 1.2%. Imagínate si solamente QQQI estuviese negativo hoy. Ahora sumarle lo negativo del X-Day, de lo que pagaron. Con todo y eso, bro, estamos por debajo de los índices. QQQI 1.02%, 1.03%. El Nasdaq 1.20%. SPYI 1.09% negativo. Como si lo bajamos aquí un poquito donde estaba ahorita, 1.14% negativo. El S&P 500 1.17% negativo. O sea, creo que mejor que eso. Bastante bien para en el ex-day. Más el mercado cayendo más de 1%. Estamos por debajo de los índices. Es verdad que el índice rebota. Estos fondos rebotan también, pero no, por supuesto, no capturan toda. Nunca van a capturar toda el rebote por la naturaleza del fondo. Pero bastante increíble. Sin embargo, aquí tenemos una situación un poco más especial. XPay, 20% de pago. Hoy no es el ex-day. Y está por debajo 1.25%. Por debajo del Nasdaq. Por debajo del S&P 500. Imagínense si hubiese sido el ex-day de XPay. Hay que sumarle aquí otros 90 centavos de caída. Posiblemente hubiese sido 2.5% de caída en el día. O sea, creo que eso da bastante a decir. Pasó otra orden de Niji a 48.80. No, pero Niji todavía a 48.80 está alta, ¿no? Comparado a los otros días. ¿O no? ¿Cuál fue el que llegó a 47? ¿Cuál fue el fondo que llegó a 47? En Neos We Trust. La verdad que sí. Te estoy diciendo que yo me di cuenta ahora mirándolo y digo, wow, increíble. IYRI, por supuesto, no está metido en ningún índice. Sí sigue a su propio, a ver, en el Dow Jones, ¿ve? Porque son los industriales, etcétera. Pero con todo eso, IYRI hoy está negativo 0.97%. Sí, ha caído en los últimos días. ¿Ve? En una semana 2.21%, en un mes 3%. Pero bastante bien también. MOPI comparado también a los índices, inclusive hoy, que fue el ex-day también, increíble. Yo lo veo como que un buenísimo trabajo. Y esto sigue cayendo. IWMI posiblemente fue el que vi en los 47. Ya, ahí está, 47. Bueno, ya yo me vestí ya lo único que me falta es ponerme los zapatos, agarrar mi almuerzo y ya irme para el trabajo. Entonces, nada, ahora sí. Ya. Vamos a ver, todavía falta hoy media hora, jueves y viernes. A ver cómo procesan esto mañana en la apertura. A ver cómo Trump procesa todo esto también. A ver qué pasa durante las próximas 24 o 48 horas y durante el fin de semana. Bueno, yo tengo que irme, señores. Así que nada, ahí seguimos hablando en los grupos, como siempre, de WhatsApp y de Discord. Nos vemos mañana en otro video. Pasen un buen día. Bendiciones a todos. Mucha suerte. Chao. Como siempre, suscríbanse al canal, denle me gusta al video, completamente gratis. Todo eso ya ustedes saben. Ok, chao.